Hello everyone, welcome to my channel. So in our previous video, we have discussed in detail about partnership accounting. So today we are going to see one sum in partnership accounting, especially relating to admission of partnership because that is the theory part that we covered in the previous session. So we will see relating to admission of partnership, how to apply the steps that we discussed so far in a practical scenario. So let me just share the question with you. A and B are partners of a firm sharing the profit and losses in the ratio 2:1. Okay. So whenever you have a question on partnership, start recording the details as uh, along with reading the question. So as soon as you read the question, immediately start noting down the points in your answer sheet. So the old profit sharing ratio is 2:1. Okay. The balance sheet of the firm as on 31st March 2022 is given. And it is as on 31st March 2022, they agreed to admit P and Q in their partnership. So what is the admission date? Admission date is 31/3/2022. The firm's goodwill is valued at 2 years purchase of weighted average profit. So goodwill measurement is required. There is a stock valuation, building valuation. Fourth point is unrecorded liability of 10,000. So we need to prepare a revaluation account. And then we have the fifth point. A, B, P, Q agree to share profit and losses in the ratio 3:2:1:1. So the new profit sharing ratio is 3:2:1:1. So this is our step one. Step one is identifying the old profit sharing ratio. Step two is identifying the new profit sharing ratio. What is step three? Step three is identifying your sacrificing ratio. Okay. In case of admission, it is sacrificing ratio. In case of retirement, it will be gaining ratio. So what is sacrificing ratio? It is old profit sharing ratio minus new profit sharing ratio. So here it is 2/3 minus 3/7 and 1/3 minus 2/7. So solving this, I guess you will get here 5/14. This will be 5/14. Sorry, 5/21. And this is going to be 1/21. So the sacrificing ratio is 5:1. So this is the step 3 that we have finished. Now what is step 4? Step 4 is your goodwill computation. So they have given you details for calculation of goodwill. Goodwill has to be calculated. There are different methods in calculating goodwill. We will see the different methods in short in a summary after solving this particular sum. So the 2 years purchase of weighted average profits of the last 3 years. So this particular admission is happening in 2022. So we have details up to the last 3 years. That is 2019, 20 and 21. Okay. Whenever the word weighted average is mentioned, that means we have to give weights for each year. So we'll be giving weights 1, 2 and 3. And the profit is 37,000, 40,000 and 45,000. This is your profit. So weighted profit is 37,000 into the weight. 40,000 into 2, which is the second year. So we are giving a weightage of 2. And for third year, we are giving a weightage of 3. So once we sum this up, we get the total weighted profit. And what is the Total of weight is 3 plus 2 plus 1. What will be your weighted average profit then? Weighted average profit is 2,52,000 by 6, which is 42,000. Okay, now goodwill is said to be 2 years weighted average profit, 2 years purchase. So what is the question? We'll go to the question once more. It is valued at 2 years purchase of weighted average profit of last 3 years. So the last 3 years weighted average profit is 42,000. So goodwill is 2 years purchase. So that multiplied by 2. This will be the goodwill of the firm. Now goodwill of the firm, in the question they have not mentioned that the goodwill should be brought in the books of accounts. So whenever nothing is mentioned, only it is mentioned that you have to goodwill is valued at so and so rate or using the so and so method, then we have to assume that the goodwill has to be adjusted through the partner's capital account. So here two partners are getting admitted. One is P and one is Q. Okay, what is the share of goodwill for P? 84,000 into 1 by 7. And what is the share of Q? 84,000 into 1 by 7. So this is the goodwill benefit they are going to get by joining this particular partnership firm. Okay, so P and Q are getting admitted because and they are going to get 12,000 rupees each as goodwill by joining the partnership currently. So what is the sacrifice that is made by A and B? Because in order to give P and Q 12,000 each, A and B are going to sacrifice. They are going to sacrifice a share of their profit in future. And the ratio is 5 is to 1. So A will get, so the total goodwill here is 24,000. So this 24,000, A will get 5 by 6 sacrificing ratio and B will get 1 by 6 the share. Okay, so the entry will be P capital account debit 12,000, Q capital account debit 12,000 to A 20,000 to B 4,000. Okay, so what is the effect of this entry? P and Q's capital account is getting debited. So their capital is getting reduced. And whom are they paying? They are paying to A and B in their sacrificing ratio. So the gain of goodwill that P and Q are going to get because of this admission into partnership, they are compensating to A and B who are sacrificing because of this particular admission. So when nothing is mentioned in the question about whether the goodwill should appear in the balance sheet or goodwill should be written off, when all these details, additional details are not provided, we have to assume that goodwill has to be adjusted through the capital account of the partners. Okay, so we need to find out what is the goodwill share that the new partner is going to get, and that new share, that the share that the new partner is going to get, he will compensate that share to the old partners in that sacrificing ratio. So this is the most important adjustment when it comes to partnership accounting, where there is a good probability that we will do some mistakes. So the next step is to prepare a revaluation account. So revaluation account is prepared to know the profit and loss whenever there is a restructuring in a particular partnership entity. So here the value of the stock and plant and machinery were reduced by 10%. When the assets value is getting reduced by 10%, asset is a debit account. It will always show a debit balance. So when you want to reduce an asset, you have to credit the asset account. When you credit the asset account, the corresponding account to be debited is your revaluation account. So stock, you are going to reduce it by 10%, which is 30,000. And building, no, not building, plant and machinery 10 percentage. So plant and machinery 10 percentage, 5 lakhs 10 percentage is 50,000. Building is revalued at 10 lakh 11,000. So there is an increase in the value of the building. When there is an increase in the value of a building, building is an asset account, so it will be debited. The corresponding account, which is revaluation account, is going to get credited. 10 lakh 11,000 minus 9 lakh. There was an unrecorded liability of 10,000. So when there is an unrecorded liability, now we have to record it. When a liability is getting recorded, the liability account will get credited. So what is the corresponding account? Revaluation account will get debited. The value of reserves and the value of liabilities and the value of assets other than cash were not to be altered. So this is the most important point here. They say that the valuation should not be altered. So whatever is the profit and loss you identify, but you don't change the value in the balance sheet. So what we have to do here is first we have identified what is the changes in the asset on account of revaluation. So now we have to identify what is the profit or loss. So here there is a difference of 21,000. This 21,000 will get distributed among A and B in their old profit sharing ratio, which is 21,000 into 2 by 3 and okay. So the first step is to divide the profit or loss in the old profit sharing ratio. So generally, again, if nothing is mentioned in the question, we will assume that the revaluation will have an impact on your balance sheet. So accordingly, the revalued figures will only come in the balance sheet. Profit or loss on revaluation will go into the capital account. But when it is mentioned separately and clearly that the revaluation impact should not come into your balance sheet, we'll have to again reverse the entry. So we'll just bring down the entries that we have made just now. So if you see, I am just bringing down the entries. Building, there was credit, now I am debiting. Stock, there was debit, now I am crediting. I am just reversing the entries now. What will be the difference? The difference will be the same 21,000. But now, where will it come? It will come on the credit side. Now it was on the debit side, now it is in the credit side. Okay. So I'm getting the same difference of 21,000. But this 21,000, now we will divide it in the new profit sharing ratio among all the partners. Okay, A, B, C, sorry, A, B, Q, P and Q. 21,000 into 3 by 7, 21,000 into 2 by 7, and then 21,000 into 1 by 7. Okay, the same thing I have just divided into in the new profit sharing ratio. So here it was old profit sharing ratio and now it is new profit sharing ratio. So what is the impact of this? The impact of this is that the new partners are compensating the old partners in the respective proportion. So if the assets are not revalued, what will happen? In future, whenever there is again a reconstruction or again an admission or retirement, this impact of revaluation will be compounding. So up to the point of this admission, the impact of revaluation should be adjusted among the capital account of the partners. So the impact of this is that when old profit sharing ratio, the Mr. A and B's account will be credited. Okay, then in new profit sharing ratio, A, B, P, Q, all four accounts will get debited. So the impact is that whatever is there in the sacrificing ratio, the P and Q are contributing towards this revaluation also to A and B. Okay. So this is about revaluation account. So once the revaluation account is done, we'll go to the final part of our partnership accounting, which is step 6, capital account. Okay. Okay. So we have the capital account. Now, what is the balance? Balance brought forward is 8 lakh and 4 lakh. Then there is reserve of 5,25,000. So whenever there is a reserve, the reserves should be distributed among the partners in their whole profit sharing ratio. So the reserve account should be closed and distributed in the whole profit sharing ratio, which is 5,25,000. 5,25,000 into 2 by 3 and 5,25,000 into 1 by 3. Okay. Now they have told that the reserves are to be maintained. There should not be any change in the balance sheet. So again, we have to just make an adjustment. So first we are writing off the reserve in the old profit sharing ratio and bringing it back in the new profit sharing ratio. So the ultimate impact will be the adjustment of the respective part of P and Q to A and B in their capital account itself. 3 by 7, 2 by 7. Okay. So this 75,000 each, they are going to bear, the P and Q is going to bear it, so that in future they will be, whenever the reserve is getting distributed, they get the respective share. So reserve, write off in old profit sharing ratio and then create again in the new profit sharing ratio. Distribute our revaluation profit or loss. So revaluation account, first we have to distribute the profit in the old profit sharing ratio and then adjust it again in the new profit sharing ratio. Okay. Then we also needed an adjustment with respect to goodwill. So goodwill, how much was the goodwill amount? Goodwill amount was 12,000 each, which has to be brought in by P and Q, distributed to A and B in this ratio. So P capital and Q capital, A account will get credited with 20,000 and D with 1,000, 2,000 each. So 4,000 and this is 10,000, 10,000, which is 20,000. And here A capital account and B capital account. P and Q's account will get debited with the same amount. P has to bring 10 plus 2. Q has to bring 10 plus 2. Just 12,000. Okay. Now we'll go back to the question. P and Q were to bring capital equal to their share of profit, considering B's capital as the base after all adjustments. So they have not given us what is going to be P and Q's capital. P and Q's capital is going to be equal with keeping B's capital as the base. We need to calculate what is P and Q's capital. So the balance in the capital account of B here is 4,30,000. Okay. So if 4,30,000 is 2/7 share, Then for 1/7 share, what should be the capital of P and Q? So 1/7 share is 4,30,000 into 7 by 2 into 1 by 7, which is 2,15,000. So 2,15,000 is the balance carried forward of P and Q. If P and Q are were to bring a balance of 2,15,000, they have other amounts also which they'll have to bring in towards goodwill, towards revaluation, towards reserves. So adding all that together, bank, this is your balancing figure. Okay, this 3,05,000 is the balancing figure. Once you place 2,15,000, the balancing figure is 3,05,000, which is the amount that is to be brought in by P and Q. So once this is done, the final step, that is preparation of balance sheet. So I have prepared the balance sheet here. We have taken the same figures that is given in the question. The only change is in the capital account and in the cash part. In capital account, we are taking the closing balance that we have identified after putting all the adjustments, and bank cash or bank will be the closing cash balance that is given in the question, which in the balance sheet, that is 1,50,000 plus the amount that is to be brought in by the new partners, 3,05,000 each. So once you do these two adjustments alone in the balance sheet and all the other data is taken from the closing balance sheet given in the question, your balance sheet will tally. I hope you understood a bit about partnership accounting from this sum, and you can try to solve the sum using these steps whenever you have a partnership question in your exam, because the step by step solving will help the person who's correcting your paper also to understand that yes, you are aware of all the steps involved in partnership accounting, and even if you make one or two mistakes, you might get a grace marks for the steps at least. So you always follow steps when you approach a question on partnership accounting. And stay tuned. Thank you so much for watching, and do stay tuned uh, because we will be coming up with case study questions on revaluation and dissolution as well in our upcoming videos. So thanks a lot, and keep preparing for your exams.